Well, it was a turbulent time for financial markets last week after a hotter than expected US CPI number and a sharp resurgence in geopolitical risk in the Middle East buffeted assets across the board, with equities taking a lurch lower once more, the S&P 500 notching back-to-back weekly declines, while the dollar continued to gain ground, with the dollar index rising to fresh year-to-date highs amid rising treasury yields and lingering safe haven demand, which also puts gold to fresh record highs as well, while crude priced in increased geopolitical risk premium, trading to its best levels since October of last year. Another busy data docket awaits financial markets this week, particularly here in the UK, while headline risk remains and earnings season rolls on Wall Street as well. Plenty for myself and Ryan Littlestone to discuss in the trade-off this week. So without further ado, let's get on with the show. Well, as I said, plenty for us to get our teeth into this week. So let's bring in my co-host, Ryan Littlestone from Forex Flow Live and Forex Analytics right away. Ryan, very good afternoon to you. Usually we'd start with, maybe a little bit of back and forth around the weekend's football, but given the results, I think we best steer clear of that one.
Yeah, very much. I'm surprised you mentioned it because one of our followers said that you have to buy the beers if we do mention it. So, well done.
Well, I may or may not know that the bar is free anyway, so that one doesn't bother me too much. And I just thought I'd get in there before you tried to get any so-called jokes in about Arsenal's rather dismal performance over the weekend and the fact that we've now, for the second year in a row, decided to throw the Premier League title away.
Yeah, sounds good. Sounds about right. And meanwhile, our season is doing its usual thing and imploding in the final furlong. I'll wait for next season.
Well, at least you got to the final furlong this season. I suppose that's better than normal. Right, we could we could sit here and talk about football all day, but we shouldn't. And what we should do instead is get on with Topical Thunder, because there are plenty of key events driving financial markets right now. So I guess there's really only one place to start the show this week, and that is with the geopolitical situation in the Middle East. Once again, geopolitical tensions coming rapidly to the forefront of market participants' minds. And this evidences not only the incredibly fluid situation that we continue to see within the region, but also what we discussed on the show last week, reiterating the need for traders to remain nimble and agile in this ever-shifting situation, and a situation where headlines can and do have a significant impact on price action as and when they cross news wires. And that's exactly what we saw on Friday, where we just saw a real rush into Friday afternoon and into the evening, and the market closed to really de-risk and seek shelter in safe havens such as treasuries, the yen, the dollar, on these reports that an Iranian attack on Israel was imminent within days. And we saw that classic move into havens, gold rallying, crude rallying, stocks slipping, bonds rallying. I did think it was interesting, though, that we saw both gold and crude closed pretty much flat on the day. Some of that haven demand did evaporate a little bit as the day went on. Obviously, as I'm sure all our viewers are aware, we did see that attack take place over the weekend. Around 300 drones and missiles launched from Iran over towards Israel. Most of those were intercepted. And of course, that attack itself was not particularly surprising because it had been so well telegraphed and signaled in advance. And I think that's one of the reasons why we see markets taking on a relatively calm tone this morning and into this afternoon. I mean, if you look at the S&P future now up around about 1%, pairing most of the losses that we saw on Friday. Gold is a little bit firmer. Crude is about 1% or so softer. Treasuries selling off across the curve. And I think what we're seeing is markets trying their best to move past events. And obviously helping with this is the fact that although we are still on watch for a potential escalation or a response from the Israeli side, I think thus far the market is taking some solace in the fact that, by and large, this does seem relatively contained, and particularly important for the energy traders out there. There hasn't really been any significant impact on the crude side of things, either in terms of production or in terms of transport, when you look at things like the Strait of Hormuz. So I would expect actually that markets we'll relatively quickly focus back on some of the key macro drivers that we've been discussing for some weeks and that we'll continue to discuss in the show: the policy outlook, inflation, growth, labour markets, etc., etc., etc. But of course, I think this just helps to reinforce that headlines are still out there. Those headlines are still posing significant risks. And as you've mentioned many times on the show, Ryan, just speaks to the importance of the number one rule in trading, which is always capital preservation.
Yeah, very much so. And as you said, we saw that on Friday. But even funny, we got gold rallying. I think it probably became a bit too rich up at that 2,400 handle, and people thought, well, okay, well, let's take some profit there as well. But yeah, we're in such a state with markets at the moment that it does sort of have this goldfish mentality where if we have a risk event coming on a weekend, if the world hasn't ended by Monday morning, it's forgotten about and we get back to normal. I don't think this cloud has lifted yet because Israel, may retaliate back. But it depends on what sort of scale that happens on. If it's just going after the Iranian proxies, the Houthis, and so on and so forth, then that'll be a sort of a lesser step than directly hitting into Iran itself. And you just have to wonder if there is a bit of gamesmanship on both sides, particularly from the Iranian side, just to say, we said we would retaliate. We have retaliated as far as their domestic population, or most of their population, concerns. The leaders have done what they said they would do. But in reality, it hasn't caused too much damage, thankfully. And let's hope it doesn't in the future. So, yeah, there's still this hanging over market. So, one errant headline and risk will kick off again. But otherwise, the market is tentatively getting back to some sort of normality.
Yes, I would fully agree with that. I think there is a fair degree of sort of posturing and saber rattling going on with all of this. But, naturally, the market can't just go, oh, this is posturing, we'll ignore it. You are going to hedge your risk and close out some positions and trim your exposure as and when these headlines do cross the wires. That is obviously the logical response. And if we do see things, as you say, heat up once more, then you would expect perhaps a similar response. But every day that goes past without an escalatory headline is another day that markets are much more likely to sort of turn perhaps a blind eye to the situation and focus back on the macro side of things, as we saw actually when the conflict between Russia and Ukraine began. That was initially, a really significant driver of sentiment. A week later, less so. A month later, less so. A year later, 18 months later now, actually maybe even longer than I think we're 2 years in now. Markets, couldn't care less, to be frank, about the situation there. So I think as the longer it goes on with this sort of tentative calm and quiet, without obviously wishing to tempt fate, then I think that the market should be able to move past the weekend's events in relatively short order. And one of the things that markets is likely to move on to is the Fed policy outlook, which is suddenly looking a hell of a lot more interesting than it was 7 days ago.
Yeah, very much so. We discussed it last week, whether the CPI data might give the Fed some sleepless nights, but it seems it might give them some nightmares instead. That hot CPI and PPI data. What's that?
Sorry, sleepless nights and nightmares. You say my puns are bad.
Listen, my puns walk all over your puns, mate. I'll tell you that. We should put it to a vote, actually. But I'm going to pun away, mate. But as I said, that CPI and PPI really got the market pendulum swinging more to the hawkish side once again. Fed heads last week refrained from talking about not cutting at all, unlike Kashkari and Goolsbee did 2 weeks ago. But still, the mood from speakers last week was one of no rush to cut, and that confidence might be a little bit shaken at the moment. Now, as expected, the market repriced once again with June, July, and even September getting the boot for cut hopes. The market pricing is now roughly around November, towards December as the time when the first cut will come. As for the banks, well, another sterling show in forecasting prowess from that lot. I won't say too much about that right now because my thoughts on the banks. I know you'll get upset if I go ranting on about the banks, but we've had the banks, some banks, going from forecasting 150, 175 basis points of cuts coming into 2024. Now some of them are pricing only 25 pips of cuts, and those cuts started in December. And as I say, that's all I'm going to say on that matter is, as I'll get upset and lose even more hair ranting about those bank forecasts. Suffice to say, we now need to hear from the main man now, Powell. Again. And Powell's speaking Tuesday evening, and I think that's going to be a real big deal for these recent moves and this hawkish twist in the market. It's going to be a big event to see whether he continues his current line that it'll be appropriate to cut rates this year, or if indeed he starts to waver and takes a more hawkish stance. So I've got a question for you, Michael. What will we see first, a hike or a cut?
Oh, sorry, I was expecting a difficult question. A cut, obviously. That's the no-brainer.
I think definitely go for cut. So with all the inflation and retail sales that we've just seen today, you think a cut is still coming, do you?
100%. I think the Fed cut before they hike again. I have absolutely no doubt in my mind that is what is going to happen. There's a few reasons for that. Let me go into it. You mentioned retail sales. Obviously, as you said, retail sales, what the control group measure was up 1%, 1.1% on the month in March. Very, very strong. Clearly, that phrase never bet against the US consumer springs to mind. What I would say, though, is that retail sales is a nominal figure, not a real inflation adjusted figure. So inflation hotter than expected, retail sales higher than expected. To what degree is that beat simply being driven by people being forced to pay more for the same amount of goods? I will leave that to our viewers to discuss in the comments. I think in terms of the Fed's next move, if you listen to the commentary from FOMC members, there are 19 of them, and they all seem to speak pretty much 3 times a week at this moment in time. There is only one of them who is actually talking about the prospect of further hikes, and that is Governor Bowman. And she has been talking about this for some time now and is very much a hawkish outlier on the FOMC. All of the other members are saying, if inflation is more stubborn than expected, we keep rates higher for longer. We delay cuts. We push them back towards later on in the year. Bostic, for example, one of the other more hawkish members on the committee, talking about cutting rates in the fourth quarter rather than in the summer as we previously expected. So I think it's more about that timeline shifting back and perhaps the easing cycle becoming shallower rather than the Fed taking rates into more restrictive territory. But I think just from a very, very final point on this, from a calendar perspective, I think a June cut is almost certainly off the table at this point. Remember, the Fed are saying we need to see confidence that inflation is returning towards the 2% target. Now, they're deliberately not telling us what they want to see and what that confidence actually looks like, but you would assume that it's a trend of inflation reports moving in the right direction. And we've now only got, we've got one inflation report, and the second CPI number is actually due on the day of the June Fed meeting. So while they'll get that figure in advance, I don't think 2 more CPI reports is going to give them the confidence they need to say inflation's going back to target. So I would say the earliest you can pencil in a cut for is July. And actually, I think that may well be when that cut does come. And I think, we are now sat here talking about, are we going to get 25, 50 basis points of cuts? I think the hawkish repricing has gone a little bit too far. And all it's going to take is, one negative non-farm payrolls print or one double-digit non-farm payrolls print. And all of a sudden, we're back here going, actually, maybe the dots are right. Maybe they are going to go 75 this year. There is still a hell of a lot of data out there. The Feds say they are data dependent. If they are, then that data is going to keep swinging pricing around all over the place. And, we obviously hear from the Fed next on the 1st of May. We've got a PCE number before then, and then the jobs report on the 3rd of May. And I think that is going to be absolutely pivotal if we do start to see any cracks emerging in the labour market.
Yeah, I think you're right. I can't see a hike coming. It would need, getting inflation back above 4 or 5% to get them thinking about hikes again. But I think that the problem they've got is one of communication again. Powell has stuck to the line that he sees it still appropriate that they will cut rates this year. But every month we pass, every week we pass, we're still getting better data, good data that suggests, is it going to be appropriate to cut? And I think that's the risk right now that the market is, I don't think it's there yet. It's on its way to getting to extremely hawkish. And it won't be long with data like this before the market does start pricing those hikes, even if that may be the incorrect outcome.
Yes, indeed. And I think actually there is a case to be said that, the only reason we're talking about cuts is because the Fed have told us they're going to cut. If you ignored everything the Fed had said for the last 18 months and, you just landed from Mars or whatever, and someone threw a US economic dashboard in front of you and it just showed the actual trends in key variables, GDP growth has been above 2% for 7 or 8 quarters. Non-farm payrolls, the 3-month average is at a 1-year high. Core inflation is stuck at sort of just shy of 4%. You're not going to look at that and go, the economy needs a rate cut right now, are you?
Exactly. That's exactly the point. And I bet the Martians would say it's probably appropriate for them to hike.
Well, very much so. Perhaps they would. I mean, the Martians might make more sense than central bankers at some stages. Certainly, those central bankers down the road there over at the Bank of England, who are going to have a lot of data on their plate to digest this week. It is a very, very busy week of economic releases here in the United Kingdom. We kick off on Tuesday, and actually the data will be out by the time that you watch this video, so I won't dwell on it too much. With the latest labour market figures, unemployment expected to tick marginally higher to 4%. A slight cooling should come through in average hourly earnings growth. I would just say, though, that we do still have these lingering issues with the ONS redoing the survey. That will not be resolved until September, which is, quite frankly, ridiculous. But you cannot really trust the unemployment data. It's not really worth the paper that it's written on, to be quite honest with you. So what's going to be of much more importance in terms of the BOE policy direction is the inflation figures that we get on Wednesday. We're expecting a further fall in both CPI and core CPI. The headline metric is seen coming down to 3.1 from 3.4% previously. This data, of course, referencing March. The core metric seen coming down to 4.1 from 4.5% previously. And of course, the services CPI number, which is something that the BOE are watching very, very closely for a sign of underlying underlying inflation persistence. That services CPI print is set to fall below 6% for the first time since all the way back in August of 2022. And data roughly in line with that consensus would continue to see the economy on a course to achieve the 2% inflation target, albeit briefly, probably in both April and May, although a lot of that will obviously be driven by energy prices, as we've discussed previously. And then we mentioned the US retail sales number earlier on. We get our own retail sales print out of the UK on Friday. Headline sales expected to have risen by around 1/3 on a monthly basis in March compared to the stagnation that we saw in February. And actually that should help to reinforce what we saw in last week's GDP data, that the economy is, and what we see in the PMIs incidentally, that the economy continues to recover, not particularly rapidly, but recovering nonetheless from that recession that we fell into in the final 2 quarters of 2023. BOE pricing is pretty delicately poised as we come into this week. Markets are pricing around a 50-50 chance that the old lady delivers the first 25 basis point rate cut in June. That cut is fully priced by August, and there's just under 3 rate cuts in the OIS curve by the end of the year. So, Ryan, I guess the question for you is, how do you see that potentially shifting as we move through the week ahead, and which way are the risks priced? We were speaking, the Fed, we may have got a bit too far in that hawkish repricing. What's the situation in terms of the BOE rate pricing at the moment?
Yeah, well, firstly, maybe we should have got a 2-for-1 deal on Bernanke after his Bank of England forecasting review. We should get them in at the ONS as well to tidy those guys up. But September before they fix this it's mind-boggling. We used to lead the world once upon a time, and now we can't lead a sheep down a path. Anyway, in answer to your question, I think it is going to be a big week for the Bank of England and those rate expectations. The thing with the UK, it's always a case. It's always a matter of extremes. We're either doing really well or really, really badly. So it's strange to have this sort of middle ground that we're in at the moment, where we've sort of got green shoots and potential recoveries. So you've got to question whether that's going to last, with rates continuing to be as high as they are. I've said for a while coming into this year, the UK is maybe more at risk from those high rates biting than, say, the US, which has been proved the case at the moment. So, I think whatever you make of the jobs report, we're going to move on the numbers. Those wage numbers are very important. The BOE will want to see those coming down significantly just to take some of the heat out there. Inflation, if we get a 2 handle on the CPI numbers, then I think that's probably going to be do the most damage to the pound and up in those rate cut calls. Obviously, that's on the headline. The core is going to still be sitting pretty high, but maybe if it we see a big surprise number, 3.7, 3.6, that will also add to those dovish calls that we get from the market. Retail sales, they're going to be a bit of an outlier. They could just as easily come in up 1% as they could come in down 1%, and it's going to be on a Friday, late on a Friday, so we'll be past them, everything else that we get. Is June underpriced? I don't know. I still think June's a bit of a push to see the first rate cut, unless the data really comes tumbling down, which is always possible. But I'm expecting things maybe to still be a little bit sticky on the inflation front, running closer to June. And that May meeting is all important, because that's when we get the next monetary policy report with all those forecasts coming in. So, heavy data. I doubt I'll be up for any of it because I'm still on strike from watching 7 a.m. data. We'll see what happens.
If anyone at the ONS is watching, can you just go back to releasing this at 9:30? It was much easier for everyone. Just lastly on the UK, so are you first BOE cut in August? Is that your call?
It's a good question. It's
That's
definitely
why
going to be after June. And I can't see one coming in June. Will it be enough in August? I'd say it's probably I'm 70-30 on August. Let's put it that way.
And the 30 is after August.
Yeah, I'm just not confident that the data is going to come down on inflation quick enough to get them talking about cuts or bringing it that soon. So this is one of those moments, and you've got it on film, where I'm actually not too sure about what they're going to do, because this is the Bank of England. They're going to be dovish whatever happens. So in that case, it's probably 100% for June.
Well, no, I was just thinking, you're not sure what the BOE are going to do. I'm not sure what they're going to do. I think they'll probably go in June. But what I can guarantee is that the 9 of them on the MPC, they have not got a clue what they're going to do, given the recent track record. Right, before I bash the Bank of England anymore, let's have a look at what else is on this week's economic calendar.
Yeah, so you've covered obviously the UK data, and we do have some other key data points to watch this week. And inflation features broadly, starting with Canada and New Zealand today, which is Tuesday as you're watching this. Now, Canadian CPI is expected to come in largely unchanged at 3.1% in the headline, and roughly unchanged 3 to 3.2% in the 200 core measures that they like to look at. Kiwi CPI is the Q1 number. That's expected at 0.6% versus 0.5% previously, quarter on quarter. The year-on-year figure coming in lower at 4% versus 4.6% previously. Now, both of these numbers will be viewed in context of the 2 BOC and RBNZ meetings that we had last week, where both have sort of maintained their restrictive language rather than moving to any sort of explicit cut language, although Macklin was slightly more dovish than the statement in his presser last week. Now, early Thursday, we get Aussie jobs data, and we'll be watching to see if last month's blowout, nearly 117,000 gain was a bit of a one-off, and that gets reversed, or if it's maybe the start of a bit of a positive trend. Now, the jobs market heating up will be of big interest to the RBA, especially if it brings inflationary pressures from wages along with it. A more modest 7.2k is expected for that data. Then on Friday, we've got CPI out of Japan, and maybe looking to match the moves we saw a few weeks ago in the Tokyo CPI. That saw the core coming down to 2.7% and the headline looking to be unchanged at 2.8%. Now, again, a hotter number will raise some expectations for another Bank of Japan hike sooner, while being closer to maybe 2% in that inflation number. We'll see those remain well into the future. Now, we're in a world where interest rates are really now being benchmarked to the Fed timeline, and these data points are now increasingly important for their respective currencies versus the dollar. So any different shifts in that is going to all be played against this Fed timeline. And as we've seen with the euro dollar, it has a big impact if that timeline is going to change.
Yes, absolutely. Remarkably comprehensive and concise roundup, and you managed to do it in the 2.5 minutes as well. Well done, mate. I really don't have anything to add to that for once, apart from to say, as you rightly made the point at the end there, we are now really, I think, in the realm of policy divergence starting to drive, particularly the FX and rates markets much more. It's a theme we discussed very early on in the year that we're going to see the direction of travel for monetary policy is easier, and it is normalization across G10, but it's going to happen at differing paces, and it's going to happen to a differing extent. And what's going to drive those divergences and what's going to drive the differences in central bank rhetoric, it is obviously the economic data that we're getting. So I think, we are in an environment where, as you say, we're going to benchmark everything to performance in the United States, and where we are seeing data that has more dovish implications, be that cooler inflation, weaker growth, softer jobs markets, whatever it may be. I think we're going to see the respective currencies end up getting punished relatively harshly for that.
Yeah, very much so. And that's good for us and trading, because obviously we're going to look at a few pairs, and that's we want a bit of volatility and a bit of movement, because we've been sitting in some tired old ranges for recently.
Absolutely that. Well, it seems like Ryan is trying to do my own segues for me, so why don't we move on to That's a Setup. If you want to host the show, mate, we can arrange it. We can get Kyriakos to swap us around one week and see how it goes. You can have a turn in the hot seat. Right. We do need to get into some charts. And I want to start with the dollar this week. Revisiting last week's play of the day, actually. I said on the show last week I would be buying the dollar dip, and that seemed to work out pretty well. I think if you look at the dollar from a fundamental point of view, the way that we often visualize the dollar is with the idea of a dollar smile, whereby the dollar tends to outperform in an environment where we're either experiencing significant risk aversion and haven flows, or the dollar outperforms in an environment where US economic growth is outperforming its peers, rates are higher, the policy outlook is much more hawkish than its peers, and obviously you have that yield advantage as well. And I think really the dollar benefited from actually both sides of that dollar smile last week. The hotter than expected inflation figures forcing treasury yields higher across the curve, that hawkish repricing of Fed policy expectations that we discussed. And then, of course, we had that haven demand coming in on Friday as well. And it was actually the best weekly gain for the dollar index since all the way back in September of 2022, as we probed that 106 figure, and actually we've broken slightly above it in trade today, printing fresh year-to-date highs. And as Ryan mentioned, some of those really tired ranges, which we'll get onto in a second, starting to break down across the G10 board. Cable below 125, the euro, which Ryan's going to mention, below 107, the yen up towards 154, the Aussie below 65, the Kiwi below 60. And to be frank, well, I said last week buy the dollar dip. This week I say there's still little reason to bet against the dollar. It still has a yield advantage. It still has a growth advantage. Policy divergence risks favor the Fed becoming or even remaining a hawkish outlier in the G10 FX world. And I would be staying long here and actually think that the dollar is likely to outperform most significantly against the currencies, as we just discussed, where central banks are likely to ease before and ease more than the FOMC. So your mind immediately springs to the euro, to the Swissy, to the pound if the BOE go in June, to the Swedish krona, they may even cut in May. So I think it's going to be a pretty grim summer for European FX in particular.
Yeah, I think you're right, and I think the trend is your friend. I mean, it's weird again, though. You know, a couple of weeks ago, we were talking about it. You know, every time the dollar rallies, the market was there to hit it, and it seemed like it wanted to sell dollars at every opportunity. And now the switch has flicked again, and we're seeing the dollar bid, and it's bought on every dip, and the market's changed its mind once again. I think you're right on the fundamental standpoint. The data is obviously remain strong, so it's really going to take a turnaround in that data to get the dollar moving south again. The only thing standing its way is the Fed. And as I say, I keep coming back to power tomorrow. I can't overemphasize how important I think that's going to be tonight as you're watching this. So yeah, if he said, "Yep, we're still going to cut this year," then again we're going to get a flip of the switch and everything will get repriced once again. But you know what they say, we keep saying it, the trend is your friend. So I think dollar dip buying is the way forward, but just to be a bit picky. And just lastly, also for a bit of context, remember what we are dealing with here. We're not dealing with all central banks getting into a cut cycle of 300-400 pips going back to zero, anything like that. We're just going to get rates going back to zero, which may mean 150, 200.
Not zero.
Not zero, 250 basis points at a minimum sort of thing, or maximum. So, we're not talking about hundreds and hundreds of basis points of cuts, and you've got to factor that in when you're talking about FX moves, because the market's not going to move 1,000 pips on just reducing rates to 3% or something like that.
No, you're absolutely right. Well, the trend is certainly the friend, or certainly my friend in the euro, given that little wager we had earlier in the year.
Yes. Fortunately, that was a wager for nothing. So
yes, I know. I regret that now.
Yeah. Well, I'm confident I'll make sure there's something on it. But in the meantime, I know you're going to be excited. I knew you were going to be excited looking at this chart, and our friendly bet on whether 105 or 111 came first. It's edging your way once again. As we said, the dollar getting up that head of steam on the back of the hawkish turn in US dollar. It's seen the US. Sorry, I'm getting muddled now. It's seen the euro crunching through level after level. Now, as I'm fond of saying, when the fundamentals are strong, your tech levels are usually wrong. And this has certainly been time for the support levels to break. The big level that's gone is the 107 level, which puts us in range for probably another test of that 105, 104.50 zone. This level is not to be underestimated, as it's a really long historical level going back all the way to the early 2000s. It's a level I've been long from, or I was long from, since the first test, which finally hit my trailing stop last week. And I'll be considering going long again there if we test it, and depending on the reason, obviously, why we're testing that level. Now, again, this move is purely on the time divergence between the Fed and the ECB. The ECB remain unchanged in their prospective June start for cutting, while even July's on the table as well, and the Fed are potentially going to be cutting later. However, if the market starts getting too extreme in its hawkish thinking, that could mean we get a test of this 105 level. Then I'll weigh up any comments from Powell before I look to trade this 105 zone. But in the meantime, I was long from this from the last test late last year. Finally got triggered out of that, but I will be looking at that level again for potential longs.
Well, I don't have much else to say other than, we've got a big figure and a half to go until I can pop some champagne that unfortunately I will have had to buy myself because I was foolish enough not to actually put any stakes on this bet.
But you drink it as well. Don't worry about that. And this is great. Every time I speak, you're turning speechless, which is absolutely fantastic.
But I do think, as you said with the dollar a moment ago, the trend is your friend. I mean, effectively, this is the inverse of what we were looking at anyway, given the weighting the euro has in the dollar index. But, even today, we've heard a couple of ECB speakers saying, they may cut 4 times this year. I think there's no chance the Fed cut 4 times this year unless you're dealing with a significant financial accident, for want of a better word, in which case you probably want to buy the dollar anyway for its haven properties. I think that the euro is going to get a test of that 105 figure. And then I guess we assess where we are at that point. There is an argument. It's not one that I particularly subscribe to, but it's one that a few on the sell side have started making, in that actually if the ECB do deliver some pretty sizable cuts before the summer, does that improve the growth outlook in the second half of the year that actually supports the Eurozone economy and therefore supports the euro as well and sees the currency rebound? I think that's a little bit of a stretch, but it's a valid argument. And if you are looking for the euro to turn around anytime soon, it's probably the only argument you can really cling on to at the moment.
Yeah, that would be the hope for the ECB and the Eurozone. But as we say in trading, hope isn't a strategy, and that's definitely not been a strategy for the ECB in years gone past. But it's going to be interesting, and I'm looking forward to what you're talking about next, this knock and CAD.
Oh, well, go on then. Why don't we move on? Because I did want to bring up the Norwegian kroner and the Canadian dollar too, that we talk about occasionally, but what piqued my interest last week is the move that we saw in crude. Obviously, we saw that rally fizzle out a little bit on Friday, but nonetheless, it was the second week in a row where Brent crude, the front contract, has traded and settled north of $90 a barrel towards the end of the week. And we are a rounding error away from our highest levels since last October. But what I think is perhaps most interesting is that, we would typically expect a correlation between the price of crude and the currencies of major crude exporters, such as the Norwegian krone and the Canadian dollar. But as you can see on these charts here, that correlation seems to have broken down pretty significantly over the last couple of weeks. And I think there's a couple of takeaways here. I think the first is that it suggests to me that, in contrast to what we have seen, if you look back on that chart there, for example, during 2023, this time last year, where these currencies were being driven by influences in the energy market, it suggests that actually those external influences perhaps aren't necessarily the forces that are running the show in the foreign exchange space at the moment. And it takes us back to that idea that we've discussed in pretty much every segment of today's show, where it is policy divergence and therefore yield spreads that are actually driving currencies at the moment and sending the Canadian dollar and the Norwegian krone significantly weaker. The other thing that you can perhaps draw in terms of a conclusion from this setup or from this chart is that it would suggest that if crude were to continue rallying, and we've seen, the sell side are now starting to come out with calls for $100 a barrel crude, as seems to happen any time a missile goes flying anywhere in the Middle East. But if crude were to continue moving higher, then that suggests that actually perhaps these two currencies wouldn't be particularly insulated from any weakness, given that crude doesn't seem to be a significant driver of either at the moment. So I find it relatively tough to be bullish on either the NOK or the CAD at the moment, particularly when, as you rightly said earlier, Ryan, we had BOC Governor Macklem last week saying that a cut in June is, and I quote his language here, in the realm of possibilities. Well, if you get a cool CPI number this week, add that to unemployment running north of 6%, it's not going to take a lot to push the BOC to hit the button on that 25 bip rate cut at their next meeting.
Absolutely. And you'll know my play of the day last week was dollar CAD buying a dip for a run into the CPI in Bank of Canada. That proved to be a great trade. If only I managed to not muck up my execution of it, trying to be a bit too greedy, waiting for 135.40 to start, and we got down to 48, and then it was north ever since then. But this is one of those moments. These correlations have been broken down for quite a while. Even through 2023, the correlations were loosening up. And I think that's more to do, as you say, with the fundamentals, with the central bank play, the monetary policy divergence. Also, the last week or so has been the risk play as well, heavy dollar buying. And obviously that dollar twist into more hawkish has been overtaken what's happening in oil for the loonie and dollar CAD. But it's the thing with correlations, they can just suddenly snap back. If we get a resolution in this Middle East strife going on, and maybe even Russia calms down, I expect the correlations will come right back into play. But for the meantime, you have got to treat them as two separate assets and sort of forget the correlation. And one thing I say, if you're looking at oil too much to trade CAD or the NOK, just trade oil. If you're putting all that effort into looking at oil, just trade it. There's no point in just putting all your time and effort into one asset to try and trade another asset. So take them both separately. We know how they're trading at the moment, as you say. They are disconnected from oil. So take that out of the equation when you're dealing with trading these two currencies.
No, I think you're absolutely right. One of my sort of pet peeves in the markets is when you see someone, bullish on oil and they suggest some ridiculously complicated structure that involves being, long the NOK against some random EM currency. As you say, if you're bullish oil, trade oil. If you're bullish the NOK, trade the NOK. But I think the other point, just finally on this, is that actually, these correlations are not set in stone. They do change over time. Yes, we would say that these are commodity currencies. The Aussie dollar's risk sensitive. So's the Kiwi. So's the pound. That's not necessarily the case 100% of the time. So if you are trading based on these correlations, then you do need to have charts like this pretty much engraved on your screen somewhere so that you can see how those correlations evolve as the market continues to trade. In any case, let's have a look at dollar yen. And we best get on with this quickly because I think we're about 3 big figures higher than when you made the notes for this.
Yeah, I know. Every time I look at the chart and the screen, we're up another 20 pips. And yeah, well, we've had that resolution of the 152 level. The popcorn show has ended with a break, to the upside, and we haven't taken long to rally up through 153. And as of recording now, we've just busted up through 154 on the back of very strong US retail sales. So it's been no surprise to see this tacking on a couple of hundred pips following the break, as the pressure was really building while we waited to resolve what was happening at 152. What hasn't appeared is any intervention, but just more jawboning. So we're still on red alert for that. It's important to always gauge, though, what the driver alpha moves are in the M pairs in general. And for dollar yen, we've obviously had that hawkish move for the dollar, which is not something the MOF can do much about. Now, talking about the techs, we've got a bit of daylight here up through 152. So I favour switching to the very, very wide charts and the long-term view, just to see where the next levels might be popping up and the next levels of interest. As you can see, the fibs play an important part of my setups, and we've come through some 38.2 fibs from the 1980s. Both of these have been substantial levels, fairly significant levels, especially the green one you can see there at 147. If you look at your charts more closely, we've had plenty of action around that 147 area. The next main fib that I've got is back from 1975. I was 3 at the time. Mike was probably just a twinkle in his father's eye at that point. And that's up at 163.88, so quite some way away. Before that, though, we do have several weekly tops up around the 160 area to deal with. So that's probably going to be my main focus in terms of a longer view on the charts of where we may next get the price running into trouble. Right now, I'm still really loath to trade this due to the continued two-sided risk. You know, you go long, you face that intervention risk. You go short, it costs you money on the carry. All the while, it's looking extremely bullish. However, that's one of the reasons why I look at these wider charts, just to try and highlight the big levels that may just be too good an opportunity not to trade. So I'll give Michael yet another chance at price guessing. What's next, 150 or 160?
Well, are we actually going to have anything on this one, or am I just guessing for the fun of it again?
Go on then, what do you want on it? You can call it.
Oh, no, we'll do it just for fun.
No, we won't. No, you said it now. Come on, what are you putting on it? We're going to have another lunch on it?
Yeah, that would do. 150, I reckon. I think the medium run direction of travel is higher, i.e. weaker yen. But I think it is just starting to get to the point where, you know, another couple of big figures, the Ministry of Finance will probably try and step in. Do we see Treasury bears begin to take profit? Do we see dollar bulls can start to take profit here? I think we would see perhaps a modest pullback before we accelerate higher once more.
Yeah, well, I said it was price guessing. I'm going to go for 152. So if it comes in right, then we'll share lunch.
Well, there we go. That got round that issue. Right, let's have a look at our plays of the day. Right, so I want to look at the S&P 500 this week. I'll keep things relatively short and sweet. The S&P 500 is up by around about 1% on the day, although we do still trade about 3% off the contract high that you can see marked on the chart in green there, just north of 5,300. Obviously, we had that move lower over the last fortnight or so, but I think it was important for the technicians out there, at least, and the momentum traders and trend followers, that we did manage to close above the 50-day moving average on Friday, despite that broader risk aversion that we saw and despite that relatively subpar start to bank earnings season. So I think the balance of risks continues to point to the upside here. Economic growth remains very, very resilient and strong, as we said. I would expect Fed policy to still become increasingly supportive as we move through the year, albeit perhaps those cuts have been delayed. And of course, the central bank put is alive and well once more. So I think dips in the S&P 500 should remain relatively shallow, should remain relatively contained. My bull case remains intact, and I would be happy to be buying into any weakness for now. Ryan, why don't we have a look at Euro Sterling?
Yeah, a rinse and repeat play of the day for me this week. I've already traded this one several times off the 85 level, firstly since last summer, and I remain core long from that level. We're looking a bit soggy again at the start of the week, so I'm looking to buy off the 85 zone once again. More recently, though, I've been quick to offload pieces in rallies towards 86 because I am cognizant that we're failing to rally too far from the 85 level. That means that this does have some growing bearish risk. This is yet another pair to watch for that monetary policy divergence between a ready-to-cut ECB and a not quite there yet BOE. And if that plays out further, I'll be eyeing potentially a reverse short if that 85, 84, 80 area breaks. So, rinse and repeat for me, mate.
Good stuff. Well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing this together as brilliantly as he always does. We hope you've enjoyed the show. If you have, drop a like on the video, leave a comment as well. Let us know your thoughts, how you're trading the markets, and if there's anything in particular you would like us to discuss in next week's episode. And that is indeed when we will be back with another show. In the meantime, have a very, very good week ahead, and we will see you then. Thanks as always for watching, and goodbye for now.